it's been Thanksgiving or like Thanksgiving really since March, right? We've had a really unprecedented sort of shift in consumption from restaurants and away from home to at-home consumption, people cooking more than they have, in probably a generation. And so as we kind of lead up into this Thanksgiving holiday, what we've seen from companies like even today, Smucker's reported earnings, Hormel this morning, the retail demand, at our grocery stores for these packaged food companies has been really unprecedented. They're running revenues up in the high single digit, low double digit range. And so as we kind of move into Thanksgiving, it kind of raises a question about whether or not there's even a little bit of cooking fatigue as we've been all sort of cooking more than we normally do.
Well, there's been a lot of banana bread, a lot of sourdough, and all that stuff there. As we looked at some of those stocks as a group, the Kraft Heinz, the Conagras, the General Mills, the Hormels, and so forth, how have they been doing this year? Are they up a lot? And does that mean that the run in them is already priced in?
Yeah, that's a great question. They had a really good run early on, right? Kind of the initial market reaction was as the situation unfolded. But really, if you look at the performance since the second quarter earnings season, so the middle of the summer, the performance is somewhat lagged. And even when you see it on a day like today, where it's risk off or risk on, I should say, and more of the risk on stocks are doing better, you've seen a lot of these packaged food stocks lagged. And I think as we move into flip the calendar to 21, it's time to be a little bit more selective about which of these food companies will sort of see a more enduring sort of demand uplift and which ones will mean revert. And, that's where we really like Kraft Heinz in that scenario, because we think there is an idiosyncratic sort of improvement happening there that's beyond what was happening with COVID. We think they'll be in a much better position as we move beyond 21 and 22.
So Kraft Heinz would be on your buy list. So I see is Constellation Brands and Conagra. Constellation, presumably a beverage play, because people will be home drinking wine and other beverages out of their roster of goodies.
Correct. And Constellation Brands suffered a little bit this summer because they had COVID-related supply chain issues. They had to close their brewery for about a month. So in the middle of the peak summer season, they were out of stock, basically, which hurt market share. It's already ripped back. Even latest data out today, sales are back up in their beer business at a high teens rate. And so our expectation is, the valuation's compressed a bit, and it's really a growth stock that got sort of mispriced this year because of this short-term transient effect. And we think they kind of get back on track. Right. Really, it started now, and we'll have a really good calendar 21, and we think that stock sets up really well.
Right.
And Conagra's kind of interesting because, Conagra pre-pandemic looked like it was maybe struggling to hit its multi-year goals. Now they seem to be very much on track to do that. The balance sheet's improving. And I think a key question there is they do sell quite a few convenience items, things like frozen meals, frozen foods. And, one of the things we've seen in our research is convenience has been very important for consumers, even in the stay-at-home dynamic. And so are some of these products that, like Bird's Eye frozen vegetables, for instance, does demand there stay elevated as consumers sort of stick with things that have worked and, importantly, things that are convenient?
Right.
Shepard Smith here. Thanks for watching CNBC on YouTube.